In the never-ending tug-of-war between economic growth and price stability, the latest data suggests inflation still has the upper hand. For months, Americans have been bombarded with eye-popping statistics on rising costs for everything from groceries to gasoline. Now, we have new figures showing that core inflation remains stubbornly high even as growth sputters. The current state of affairs confounds the conventional economic wisdom that overheated demand inevitably cools as the Federal Reserve applies the brakes through interest rate hikes. The central bank has indeed raised rates aggressively over the past year in its campaign to wrestle inflation under control. But Thursday's report dashed any hopes that this bitter medicine would swiftly restore price stability without severely stalling the economic expansion. The annualized 1.6% growth rate for the first quarter came in well below expectations, a marked slowdown from the end of 2022. Perhaps more worryingly, the Fed's preferred gauge of underlying inflation jumped to a hefty 3.7% annual pace. At a time when growth should be moderating enough to relieve price pressures, we instead seem caught in the dilemma of feeble expansion coupled with elevated inflation, the dreaded phenomenon known as stagflation. For the White House, these crosscurrents present an especially tricky political challenge heading into the 2024 election season. President Biden can rightly claim that the economy remains on a path of growth, albeit slower growth. He touted the latest GDP number as continued steady and stable performance, projecting an air of measured reassurance. But Biden also acknowledged that costs are still too high for American families struggling with punishing levels of inflation after a year of interest rate hikes aimed at taming those rising prices. The Federal Reserve now confronts an agonizing policy dilemma after over a year of inflation-fighting efforts. Having already pushed its benchmark rate above 5%, the highest level since 2007, the central bank must weigh whether still elevated inflation warrants even higher rates and a higher risk of recession. Some pessimistic forecasters see little choice but a further ratcheting up of borrowing costs to finally break the inflationary psychology that has taken hold. More optimistic voices, however, believe the rate hikes have already cooled demand sufficiently for inflation to soon recede without overly slamming the brakes. Ultimately, this latest batch of statistics fits into a broader narrative that has defined the pandemic era, a tale of imbalances, shortages, and intractable price pressures that have dramatically complicated the path back to economic normalcy. Resilient consumer spending and a sturdy jobs market kept the economy expanding through the Fed's rate hike campaign, but that very strength has made it harder to tame price growth emanating from snarled supply chains and wage pressures. The current outlook lays bare the flimsiness of rosy scenarios touting a fabled immaculate disinflation in which price pressures simply melt away without severe economic fallout. Instead, these latest numbers point toward a grittier reality of hard-fought incremental progress against inflation, a grinding campaign more likely to resemble trench warfare than a peaceful march to victory. We may have to resign ourselves to living with inflation rates higher than the Fed's 2% target for some time yet. For better or worse, price stability has been the lodestar of Fed policy across multiple chairs and administrations in recent decades. That commitment will now be sorely tested against backdrop of disappointing growth and sticky inflation. How the central bank navigates this perilous middle ground will have profound ramifications for American prosperity and the public's faith in the institution's statutory mandate. Critics of past Fed decisions faulted the central bank for being too slow to recognize inflation's resurgence, falling behind the curve. Today, the opposite mistake looms, over-tightening into economic weakness and unnecessarily prolonging a period of subpar growth and financial strain. Threading that needle will require judicious policymaking and deft communications from the Fed at a time when economic forecasting has rarely been more fraught with risk. We are living through an inflection point, a juncture where the path to sustainable growth and price stability has become inescapably arduous. For the central bank and the White House alike, the days of easy choices are over. Only flinty-eyed realism and durable public patience can now shepherd us through this latest bout of economic instability.